Hey everyone, my name's Andy. My channel's Finding Value. If you like making money, I would click subscribe. We talk a lot about financial opportunities. So it's a financial education channel. We talk about investment opportunities that are out there. And if that's something that interests you, I would click subscribe. It's a lot of commodity type stuff. Join our community, join myself, and let's ride this commodity bull market up together. We would love to have you. So one of the comments I wanted to address, I looked through the comments. Thank you for commenting. One of the comments is, can you do a video on your red positions in the hypothetical portfolio? A big part of winning is cutting the losers. I'm in it for the long haul. So they want me to go over some of the positions that are losing in the hypothetical portfolio. So if you guys kind of just joined, the hypothetical portfolio is a portfolio that I created January 8th was the beginning of that portfolio. So it's about almost 4 months. Next, 5/8 would be 4 months. And I've got the portfolio right here. It's in the background here. You'll lose me. Well, I'll just shrink myself a little bit. So I've been going through this portfolio. I've been adding companies. I didn't add them all January 8th. I've been adding them and picking them off where I think is a good buying opportunity. Right now, over that 3.5 month period, we're up 30%. That's not bad. And there was a couple that I would say that whether it be timing or maybe my pick was just bad, but we're looking at the ones that I didn't do very well on. So looking at this, I'm going to discount these ones at the top here. So these ones up here, I wouldn't really say, I just added them. So I wouldn't really put too much weight on these ones up here. But I added some of these royalty companies. I did a really good job. I thought, almost a bottom here. So Cisco Royalty, Sandstorm Gold, Franco-Nevada, Royal Gold, Wheaton Precious Metals, Metalla Royalty. These were pretty good pickups. So we're going to scroll down. Free Gold Ventures, I still think this one could be a good one. You could see I bought it twice. This one's still down. I've got Leading Edge Materials, which is a rare earth metal company. That one's okay. Some of these are pretty speculative, so I wouldn't put a bunch of money in them. I just kind of pepper them in a little bit. This one's Global Lithium Ion. Again, this is a really small speculative one. It's up to you if you want to add in, but this one is down 12%. I really, with $1,000 in it in this portfolio, I wouldn't really do much with it. I just leave it. Is it going to be the next big one? I don't know. That one is highly speculative, so very high. So I don't know. I mean, if I were to cut one, I'd rather cut GBBGF versus all the other ones because I like the royalty companies. I can put money there and I'm comfortable. GBBGF. It's more of a very highly exploration type play. I'm more inclined to cut my exploration plays than I am my producers or royalty companies. We've got TDRRF. This is another exploration gold play, highly speculative. But guess what? They're finding gold. It's in a pretty good spot up in the Golden Triangle up in Canada. I think it has a very good potential, especially if price of gold goes up. I'm just going to leave it. I think that's a good one. Deep Yellow, I'm actually basically flat on that. That would be one I would add into. There's Appia Energy. I'm up on that. Now, Westwater, they came out earnings. They disappointed on earnings, and they pulled back quite a bit. So that one right there, I would say, is a definite loser in terms of the portfolio. It's down 45%. So we look at the chart here. We have this nice big kind of pullback. I was hoping this thing would continue. This is when they released that information and it sold off. Now, I think we're kind of down in an ABC correction. I think it's already done and we're starting to pull on up. So I'm not going to do anything with it. I'm just going to hold on. I think momentum-wise, I think it's changing and going to go to the upside here. Another one, looking at the portfolio, Lightbridge. Lightbridge is down 28%. I checked the chart on this guy. Nice, good pull up, kind of a ABC correction. This thing looks like the correction's just done and it's about to head on higher. So what I'm going to do is I'm going to do nothing. The correction's done. We lived through this correction. It was a mistimed purchase. That's what I would chalk it up to be. And if anything, I would be adding into it at these levels. I wouldn't be selling it. So the chart looks good. I think it's gonna head on up when uranium heads up too. And I'm just gonna hold on to it. These other ones, they've all done pretty well down here. CPE 130%. That was a huge pickup there. I actually did a video on this for the channel. I called it our new cheetah to the cheetah coalition. You can even look back. I bought that. Look for it around the beginning of February, the video. And Callan Petroleum is one that we added to our cheetah mix. It was $14.67 is when I bought it at the portfolio. So that's kind of where I entered in it. NXE, FCUUF, Global Atomic, they're all killing it. Crew Energy, Antero Resources, Southwestern, Laramide. So on this Laramide, I got it 128 at 20 cents. The thing popped way down. It was like this fluke of a sell-off, and I was like, ooh, buy. And I obviously was like, I'm buying Laramide here because of the nice, huge reversal day. It was perfect. I timed that one very well. That one's up almost 100%. Going on down, I'm not seeing too many losers here. I'm going down, TTI up 100%. Going down, okay, baseload. Baseload's down 31%. They have a reasoning here. You can see me cost average in here. If anything, I would add into it. So James Sykes is the CEO. I talked to him over the phone. He's a good guy. They're having trouble with some natives. They're in talks. He was going to do a gravity survey and then do some drilling this winter. It looks like the natives there didn't want him to continue. So they're still in talks. They're not comfortable with him proceeding. They felt like he kind of just rushed onto the area, and maybe they thought that they weren't 100% in lockstep with it. So they're going to approach this thing. I think it's going to get done. Just take some time, and they're punishing the company for that, I think. So it is down. If anything, I would be adding into it. I wouldn't be detracting or taking money out. I still think the narrative's there. Once they find the results, that's what I'm really interested in. I'd like to see the gravity survey results and some drilling results, because if they got something, they have a lot of opportunity on that shadow project. So I'm sticking with it. I'm definitely not selling my stake. And definitely not selling the hypothetical portfolio. So scrolling on down, Norilsk Nickel's up 8%, but this is one that I really like. They had an accident, and the stock sold off. In my personal portfolio, during that sell-off, I added into it. I added quite a bit. So that was one that I really enjoyed having a sell-off where I could purchase into it. Recap is up quite a bit, 103%. That's turned into a very large position. Encore Energy, all these are good. I'm just going to kind of scroll down and look for some losers here. Here's some Goviax is down a little bit in EMX. Again, I like both of those. I don't think I timed those purchases badly at all. I did cost average in some. So I think both of those, I think this whole portfolio, I like all of this portfolio. I wouldn't do a single thing. And remember, I've only had this portfolio for 3.5 months. So really what you're gauging here is how well of a market timer I am. That's really what you're gauging. You're not even giving it enough time to really, what I would say, fundamentally have these companies, work fundamental wise. Because 3.5 months is not long at all. And where I would be adding today, if I were to look at some of these companies, Baseload is one that I would probably add into. Again, that's a uranium exploration company, a little bit more high risk. It's up to you guys what you want to do. I can't give you guys recommendations, but what I can do is I can tell you what I'm doing. And what I would do is I would add to Baseload. I would add to Norilsk Nickel. I think copper looks pretty good coming up. Those companies are a little bit higher, but they look very compelling, and copper looks like it's going to break out to the upside. So I've been adding into some of these companies where they've kind of gone sideways just a little bit, and I think they're going to head back up. So a company like Anglo Platinum America, ANGPY is one that I'll even add it to the hypothetical portfolio here. I would add to Glencore. I think that's a pretty good bet, solid bet. And I would add into maybe even like a South 32 looks really good. I don't know if I have that on the portfolio here. I might. I would buy South 32. That's SOUHY, and I don't have it on this portfolio. Oh, there it is. I'd add into this one. I'm up 10% on it. That's one I would add into. So South 32, SOUHY right there. So those are the ones that I'm looking at. Again, the silver companies also have very compelling opportunities. So I would be looking there as well. Do I think they're as good as copper at this exact moment? No. Some of the oil companies, they could be pretty good too. CDEV, MCF, SM Energy, and CPE. Those companies right there, they are high debt. MCF is not. The other three are. When you take on the high debt companies, they rocket ship when oil goes higher. But it's a double-edged sword because if they pull back, they're going to pull back. But the thing is, these guys they're in a pullback mode. You can see it through the Elliott wave. If you look at Elliott wave, you can kind of see that we're still in pullback mode. And when oil takes off, some people think that oil is going to take off in about a month, end of May, beginning of June. We could see a little bit longer sideways movement. And then if oil takes off, we're going to see a rocket ship. So what I like to do is I cost average in slowly over a period of time, and I just kind of add it in. That's how I reduce my risk of volatility against me. I know some people, I may bring up a company and they just put 100% in right then and there. I'm trying to give you guys a little bit of time to cost average in and give you guys a window of opportunity to tell you when I would be doing something. I'm not doing it where it's just one all-in shot go. It's kind of like you add a little, add a little, add a little, and if you start seeing it really start to take off, you can just say, okay, I'm going to add a little bit more or something into that strength. You don't want to be piling in on a bunch of weakness. If you see a pick and you see it really sell off, like an 8 or 10% sell off, then I would be like, let's hold on here, stop the adding in, and wait for a bottom to turn back up into strength. And when it starts bottoming and showing some strength, then I start adding in again. That's how I add into these positions. But a 3-month hold, about 30% up. Again, I've been adding just kind of random amounts. Nova Royalties, and these ones right here, I think are pretty good. DNN, Nova Royalty, Africa Oil. These are good too, because I just add them to the hypothetical portfolio. Nova, I think is going to be a really good long-term pick. I don't know what it's going to do in the short term. The way I'm dealing with it, because I think copper is going to go here. I think nickel will remain strong over a long period of time. I think copper is really the good play. So I just sprinkle it in, comes back a little, sprinkle in some more, comes back. Because remember, royalties have a lot less risk. When you're dealing with a company that is, let's say it's a one project company, or an exploration company that has 0 projects. They've got projects that they're exploring, but they haven't found anything yet. Your risk is really high, so you don't want to be piling into these continually. What you want to do is, if you've got a producing company or a royalty company is going to get, they have no risk of default really, because they're not building the mines, they don't need the money, they're loaning money to mining companies, and they're gaining a royalty from it, either a revenue stream, or they get a percent of net smelter value, or they have purchase agreements where they can buy some of the production at a certain really low price. I mean, really low, like it could be like $300 for gold, or the cost of silver, or something like that. But they have a diversified income stream that's spread out in itself, a royalty company. So I see that as really low risk with all the upside potential in a bull market. You are going to pay a little bit higher of a premium for it. So when you look at these companies, you need to say, is this an exploration company? If the answer is yes, be careful for piling it in. You want to keep that a very small portfolio allocation. If you've got a very large diversified mining company, they've got many projects in many different areas. like copper, nickel, zinc, iron ore, maybe some coal, something like that. You can use that as like a diversified income stream in itself, saying that you've got all these projects, the risk is low, they're diversified with their metals. Then you can pile in. You can keep piling into it because they're going to get revenue somewhere. And something's going to go up in a commodity bull market, even though these things are fluctuating back and forth. And a royalty company, it's the same way, diversified income stream, very low risk in my opinion, because if they have one project or two projects in their portfolio go bad, their company's like, it doesn't matter. I mean, it won't affect them very much. So the way that I view these things, the bigger the company, the more diversified income streams that they have, the better. You can pile in. If it's a small exploration company, if it's something small or they only have one project, like that's it. The risk goes way up. So you can't pile in. I would take a smaller position size. If some of these oil companies, they've got multiple areas that they're drilling in, they've got a whole bunch of producing wells. That's pretty low risk. So the way that I like to play it on the oil side, since they're producing, I like the producers that are also exploring, and then I like the ones that have high debt if you're at the lowest risk entry point. A low risk entry point is when your ratio is way up there. 50-1 is where it was October, November of 2020. We saw the price bottoming out for oil. We saw the price bottoming out for those companies, and it was a low risk entry point. So if you have a low risk entry point that these companies were sold 99% off their all-time highs, and there was risk of bankruptcy, but it was the lowest risk spot that I could ever potentially buy this thing, ever. And it looked like everything was about to turn up. You hit the high risk button at the lowest risk points, if that makes sense. So I hit the high risk button. I bought QEP, CDEV, SM Energy, and then CPE a little bit later on. But I really piled into some of those, and I spread it out amongst those because if one went bankrupt, it wouldn't hurt me too bad because some of these are so, like if they were to take off, they were going to really give you that leverage to the oil price. I still think with the ratio around 30-1, 30 barrels to 1 ounce gold, that's a really good deal for oil. Really good. So I'm holding on to all those bets, and in fact, I'm actually piling into it. Now, some people ask in the comment section, how do I handle basically cost averaging, and should I rebalance my portfolio if some of these go crazy to the upside, rebalance it to other positions? Now, this is burned into my head, and hopefully I can get the point across here, is Eric Sprott. He is a billionaire. He invests in all these really high risk exploration companies, and what his approach is he spreads it out amongst a bunch of them. Some of them go up 100-fold. I mean, big time money. His recommendation, this is what he says and what his position is, and I do agree with it, is when you find a winner, if you have a winner and you find a winner, what you do is you don't actually diversify out of it. You don't rebalance and take it from the best winners. You actually take from the losers and pile into your winning bets. You keep piling into the winners. And there's some very good truth to that, because if something's working for you, it's like, let's say you figure out a chart pattern or you figure out a sector that you really know inside and out, and your investments, you figure out something where it gives you a competitive advantage. It starts working for you. You want to pile into what's working. You want to double, triple, quadruple down on the things that are working for you. You don't want to rebalance and go to your losers. You don't want to rebalance into the losers. This isn't a portfolio where you're diversifying amongst a bunch of mutual funds. You're going into individual companies, and some of these companies will kill it. And if you have a good amount of information and knowledge about it, and they're just piling on, like they're just killing it left and right, just keep piling into it. That's Eric Sprott's approach. I think that approach is right. So what I'm doing is I'm letting my winners run. I'm not diversifying out. I'm not rebalancing the portfolio. I'm letting them run. And some of them I overweighted in the beginning, and they've gotten quite large. They are probably, some of them might even be 20% of my portfolio in certain companies, almost 10 to 20%, somewhere in there. I'm just letting them run. It's like, go run, baby, go run. If they can do another 2, 3, 4, 5x from the position that I am in today, that'll put me at like a 50 bagger in some of them. So one of them is SM Energy. If you wanted to know, it's the one I bought at $1.50. I shared that on the channel. Other ones are in royalty companies and other companies that I bought a while back for very cheap. Vale was one that I bought really cheap too in 2016. That's done very well. That I'm just letting run. So that's what I'm doing. That's what his recommendation is. He's a billionaire. He knows what he's doing. I think he's right. So hopefully all this information, you guys can figure out what you want to do with your portfolios, and it helps you maybe figure out a certain paradigm or viewpoint that you want to attack. Again, I'm not 100% in commodities. I do have a lot of commodities. I do have 401k. I do have some other money, so I'm not 100% in this. This portfolio is a commodity portfolio. It is a portfolio that is I'm buying these companies roughly the same time I'm buying in my other portfolio, in my speculative commodity portfolio, which is 100% commodities. I have maybe, I don't even know what I have, 6 different portfolios or so. I have a Roth IRA, a regular individual. I have 401k. I have another one that I never rolled anywhere from a different company. I have my wife's rollover and my wife's Roth IRA. There's a whole bunch of different ones that we've got all over the place. And some of them are dedicated to commodities. Other ones have some other stuff in it. So I'm trying to build whatever I can without moving all this stuff around. So hopefully this helps you out. Give me a thumbs up if you like this content. And thank you for listening. This is Finding Value.